Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. It's been an interesting time. I'm always interested in this stuff, though, so that's, I'm actually kind of lucky that way, How many people can actually say that about their jobs? And very interesting. In the past few years, when everybody says it's different this time, typically what the average investor means is that the market's gone up a lot, and it's probably going to keep going up a lot because it's different this time. I hope that's true for a lot of people, but that's not what I mean. It's just been really interesting to have all the various things going on at the same time. There's a lot of chaos. The valuations on stocks are not super low. They're not super high either. They're in an area where you could easily have a 20, 30, 40% correction because, quite frankly, you can always have a 20, 30, 40. It doesn't matter how low the prices are. Prices aren't a screaming bargain, but they're not grossly overpriced. I would say they were mildly overpriced, which means you can go a really long time going sideways in a market like this. There are certain sectors, certain stocks doing better than others. Most of them are technology related. So if you're in some funds or your stocks are not in that area, most of the other areas have not done very well for a pretty long time period. You go back all the way to 2021 or even farther than that. Yeah, let me see. Actually, go back to 2020. The small value-oriented companies are only up 5% since then. It's the fall, 2023. That's a long time. And that's one of the things I'm going to continue to talk about here on the radio program. It's a risk called the sequence of return. If you look at the same chart that I'm looking at, in the long run, stocks do extremely well. In the long run, stocks have a tendency to do better than bonds or real estate. They have the longer term track record is better than almost every other category. The problem is you get these long periods like the one we're going through right now where the market's just chopping, going up and down and sideways. And if you're taking money out of your account during that time period to supplement your retirement income, whatever that is, you could end up running out of money. And again, that risk is called the sequence of returns. Yeah, the market makes a pretty good buck if you have enough time. But if you're drawing from it, that is really dangerous. What is the answer there? Well, the answer is to try to run a balanced portfolio. Don't have all of your money in stocks to begin with. And how many times have you heard that? Probably thousands over the past years. But there's been some, I think the addition to modern day finance has really been an old product that was modified for the current times, and that's called a fixed indexed annuity. And we'll talk a little bit more about that. It's a combination of an underlying investment with guarantees on it, and they're pretty good. Actually, the guarantees are what you should pay attention to on those. And again, we'll talk about that in the second section of today's show. In the last part of today's show, we'll actually talk about individual stocks. I haven't done a lot with that in a long time, and I'm going to try to go back to it because, first of all, it's fun. Secondly, you can be really successful. There is a guy, it was a hedge fund manager. His name is Joel Greenblatt. He's got a website that I'm going to explain a little bit later in today's show. And what's really interesting, this guy is a professor at the same business school that Warren Buffett got his master's degree, and it's called Columbia. And he's teaching there now after having been a super successful hedge fund manager. And in fact, when he wrote his first book, I think it was You Can Be a Stock Market Genius was his first book. And he wrote it right after he'd retired from the hedge fund that he was running. And he actually came on my show to promote it. I thought that was pretty cool. But and it's very common sense, but he's got a really good way of, I think, explaining things so that you don't have to have a dictionary of financial and accounting terms to understand. Now, it would help if you had that dictionary. And now you have Investopedia, so you can look it right up online. But anyway, long story short, we'll talk about that the latter part of today's show. But I always like to start off the show talking about the economy in general, what I'm reading, what other economists are saying from across the country, and I just like to take a little poll. And the bottom line is it's close to 50-50. I mean, 50% of the people don't expect a severe recession. Now, they're not expecting a lot of expansion, okay? But they don't expect a severe recession. And then there's another 50%, about 50% that does. So people that are looking at these things, they're at odds, and I think that 50-50 is hilarious because in other words, toss a quarter. But there's no doubt that things have been slowing down a little bit. The primary reason for most of this has been a pandemic that occurred and a war that's being fought in Europe right now. So pandemic has been I want to say largely controlled. They're handling it much better because they didn't know, 2-3 years ago, what it was exactly, how what the characteristics of that virus were, and they had to figure that out and get medications out there. We've made a lot of progress along that route, and then Russia decides to invade Ukraine and block up a lot of the supply chains. So we've never seen that kind of stuff before. A big pandemic. I guess actually around World War I there was a Spanish flu, and you had a world war. So if you go back and look at markets then, though they're not nearly as sophisticated as they are today. There were a lot of stocks, though, a lot of companies publicly traded. And back in those days, most stocks would pay out 80 to 90% of their profits as a dividend. And I wish I'd do that again today. If they did do that again today, these companies would be restating their earnings. They wouldn't, by that I mean they would be saying, oh, wait, we really didn't make that much money. Yeah, I know, because now you have to pay it out in cash. You have to prove that you made it. But anyway, that's the cynical side of me. But things are actually, given all the stuff that's going on, things are really not that bad. The S&P 500 2022, it was a pretty crappy year. From beginning to end, it was down a little over 20% for the year. And what people are saying this year, it's really funny. They're going, oh, well, market's up 14.3% in 2023. Yeah, but it's still down from the peak that was reached back in December of 2021. It's down almost 10% from that level. So you're telling me that you're almost 2 years into this, and it's still down 10%, and it was down close to 30, and you're not upset? By the way, if you just retired in the last couple of years, you're probably wondering whether or not you're going to have enough money to make it through retirement. Please don't let that bother you. You can adjust. You can make adjustments. And there are other investments who are paying really good returns. In fact, that's talk about that a little bit later. But the returns that you're going to get that are guaranteed from some of the fixed indexed annuities are higher than the average investor has a tendency to make on their entire portfolio. And that's what got me starting to look at this a couple of years ago. Because I've been in this industry for about 30 years, over 30 years now, and I've watched how people invest. I've watched a lot of the advice that's been given, and it's just really, really difficult. Incidentally, if you were doing things perfectly, you had the perfect balance fund over the past 3 or 4 years, you are still questioning, am I doing the right thing? Because these big declines that happen in the stock market, and by the way, the bond market's had the worst time period it's had in about 40 years. At some point in time, and I'm in this club, by the way. I own these products. I have a fixed index annuity, and I bought it a couple of years ago. And I bought it because I'm looking around and going, wow, the valuations are not, stocks are not undervalued. There are some that are undervalued. For the large part of the S&P 500, a lot of those stocks are not undervalued, and the ones that have the tendency to be most overpriced are the big boys that make the biggest impact on the index's performance. In other words, the biggest chunk of the S&P 500 is also the chunk that's most overvalued. So that's a little rough. What is the answer? Well, what I would do is, first of all, I would use exchange-traded funds, which is essentially what we do. I would look at how they're selecting the stocks. I would focus on those that focus on the sales growth, earnings growth, and profitability of the company. If you like dividend, there are a couple of dividend models in there that we use. And that's how I'd select the stocks. If you're going to do individual baskets of stocks, I would select them that way as well. Just set out the rules that you want to use. I'll go through a couple that I set up here in a few minutes. But I would take the amount that you're going to put into stocks. You would decide that by asking yourself this question. And I know I've gone through this a ton of times. It doesn't matter. It's still relevant. And in fact, you should be, as you get older, you really don't want to put up with as much risk, or most people don't. And some people, it doesn't really matter because they've done such a good job accumulating assets and they're spending such a small percentage of their savings that if the market goes down 50%, it's not going to affect them. They could have 100% of the money in stocks and it still wouldn't affect them. Okay, that's not most of us. So here's what you do. You write down on a piece of paper, take all of your assets, whatever they are, and you add them all up. Anything that you can use to draw on for retirement. And then you take 4% of that number. Okay? So let's say it's $1 million, just to keep my math easy. You got $1 million and you take 4% of that. That's $40,000. That's what you should be able to take out this year and then increase that each year for inflation. And I think it was about 95% of all the 30-year time periods going back to the early 1900s, you would not have run out of money. But there's a 9 out of 10 chance, actually a 19 out of 20 chance, that you would still have money at the end of your lifetime over the next 30 years. Now, those numbers, by the way, 4 or 5 years ago, weren't as good. The interest rates were significantly lower than they are now, and you didn't have as a high of a projected return as you would have today, given where stocks are and where interest rates are. I thought that don't worry if this stuff doesn't make sense to you. I'm going to clean it up right now. Take your decline tolerance. That's what I call it. How much are you really willing to see your portfolio drop by, and not panic and sell? And you have to think really hard about that. Okay, mine's 35%. Why? Because I don't need the money, and I know the bigger decline you're willing to sit through, the larger the long-term returns are potentially. I also know that nothing's guaranteed, but so I'm willing to sit through a 35% decline. Well, if I multiply 35 by 2, that gives me 70. Why am I doing that? Well, if I had a 50% decline in the stock market and I had 70% of my money in stocks, I'd only be down 35%. And see how simple that is? I'm so surprised. I've been using this since, probably for 20 years. I figured this out about 20 years ago. And I see all these risk questionnaires that, these financial planners and financial planning firms like to use. And you sit down and they ask you somewhere between 10 and 50 questions, depending on the questionnaire. And nobody ever understands any of it. And they say, okay, you here's your risk profile. You're either aggressive, conservative, or moderate, or some level in between one of those three. And here's how you should invest. But I guess I'm going to have to take a real quick commercial break here. This is Bill Bullington. I'm right here on 1420 here every Saturday morning, 11 to noon. After these commercial breaks, I will be right back.
This is Congressman Max Miller. America's workforce is one of its most valuable resources. But today, our workers don't have the skills they need to compete. That's why, this year, I've been co-sponsoring bills to equip hardworking Americans for the modern workplace. Like the National Apprenticeship Act, which creates 1 million new apprenticeships across the country. The Freedom to Invest in Tomorrow's Workforce Act, which will provide more flexibility for college savings plans. And the Aviation Workforce Development Act, which will create new pathways for more aviation mechanics. Not only that, I've highlighted the importance of a skilled American workforce in congressional committees, and I've held productive roundtables and meetings with steel and aerospace workers. If you want additional information about my work to aid America's workforce, please call my Medina District office at 330-661-6654 or visit my website at maxmiller.house.gov. Paid for with official funds from the Office of Max Miller.
From an idea that started in 1967, Our Lady of the Wayside has grown to serve almost 900 children and adults with developmental disabilities throughout Northeast Ohio. It's an operation that is still growing thanks to tremendous support and generous donations like the Wayside's car donation program. You can donate your ride to the Wayside for a great tax write-off by calling 1-800-368-6262. The Wayside is also looking for people to join their team. They hire for attitude and train for skills. Visit thewayside.org to apply today.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
Well, welcome back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to call in, you can dial 216-901-0945. That's 216-901-0945. And you can participate in the show here. If you hear something you'd like more information on, feel free to go to my website. It's bill@bullingtoncapital.com. I'm sorry, that's my email address. It's bullingtoncapital.com. You can set up a free introductory meeting, kind of a get to know you. If you've got questions, it can be on the phone or in person, and I'll be glad to try to help you out if I can. And we were talking a little bit about like guaranteed income, stocks. You know, I really like stocks, by the way. I'm pretty selective on individual stocks, and we'll talk more about that in the last section of today's show, which will be after 11:45. I've been getting requests now for a long time for me to spend more time talking about it. So I'll do that. I'm gonna, and it should be fun. And it's my favorite part of the business, actually, trying to figure out which companies are going to be the best performers going forward. And that's always changing, by the way. So I really like that a lot. I really like the tools that have been developed over the past few years. When the fixed index annuities first came out, I was not a fan. I mean, I didn't use them for years. And they've changed, they modified, and I think it's a lot more fair now. I think it's a good deal for the individual investors, especially when you're looking at, guaranteeing lifetime income, and with life expectancies expected to continue to expand, that's going to be very important. Having a guaranteed source of income is a great thing. Social Security, one of the greatest inventions in mankind, as far as I'm concerned. And do you know how many people would be just destitute without that? So, this is pretty close to that, as far as I'm concerned. What is a fixed index annuity anyway? Well, fixed index annuity is an annuity that gives you a fixed or a guaranteed rate of return as a baseline. And you have the option or the opportunity to make more money than the guarantees are. My experience, though, that's probably not going to happen, that the guaranteed portion on it is probably going to outperform the investments, especially with the stock market kind of in the shape that it's in right now. It's a little bit overpriced. The growth rate's not super high, so you could have a long sideways time period, and you just can't afford to do that at some point in time. If you're within 10 years of retirement, or you're already retired, you just can't afford that length of time going by without making any money. If you're in your 40s, no sweat. If you're in your 30s, yeah, you've got a lot of time, so you can just keep accumulating, buying your stock funds, or your stock portfolios overweighted. I like to use ETFs and individual stocks too. But so the bottom line is, with the fixed index products, it's going to give you some flexibility. It's going to help you, because as I was, like the first thing that I mentioned this morning on the show was somebody who was 62 or 61 years old is going to be eligible for Social Security next year, taking it early. Again, I'm not a big fan of taking it early. I'm going to wait until probably I'm 70, because it's guaranteed to go up each year from 62 to 70. There's a guarantee there, and it's a pretty high guarantee. So I'll put it off and then start taking it. That's just me. When's the best time to take it? When you need it. If I were to be if I were to become disabled, if I had a big accident or something like that, I'd go ahead and take it. I'd start taking it. Yeah, why? Because I needed the money, and at least take a much harder look at it. So that's another thing that I see advertised a lot. A lot of seminars on when's the best time to take out Social Security. Well, reality is, unless you know exactly how long you're going to live, and you know what the cost of living increases are going to be in the future, okay, you've got to have a crystal ball that works to know both of those things. So really, the best time to take it is when you think you need it. And for a lot of people, it's not even going to matter. I know I had a college professor who donated. He was still working, past Social Security age, and he was donating his to charity. That's great. So every situation is just a little bit different. And again, if you want to talk about your own situation and have me run some numbers for you, feel free to call 330-664-0700 or go to my website. It's bullingtoncapital.com. Fill out the contact us form, and I'll get back to you. So the bottom line, going back to this illustration, I had somebody who's 61 today, they're going to be eligible for Social Security next year. So you put the money in today, and with this particular fixed index annuity, you have to wait 12 months to turn the income on. So you're going to have to do a little bit of planning there. But so if you went in at 61 and then at 62, you decided, well, I'm going to take the money out. I put $100,000 in. Next 12 months from now, I'll get $6,415 guaranteed lifetime income for as long as I live. Now, you can also set this up jointly for a spouse. The income may or may not be lower. It depends on the age difference between the two of you. If you're the same age, it's going to be the same. If your spouse is older than you are, it's going to be the same. If you're older than your spouse, it might be slightly lower. So you have to get an estimate on that before you actually decide that you want to do that. And again, this stuff takes me 10 minutes to pull up, if that. And also, I can send you a link that'll take you to a page where you can put your age in there, the amount of money you're thinking about, and whether or not you have a joint annuitant. If you're married, you may want to do that so that your spouse continues to collect the income if you're not there. Maybe your spouse is rich and doesn't need it, so you don't have to include that. Everybody's a little bit different. And that's one of the things I think oftentimes over the past 30 years, sometimes people get a little frustrated because I'm not speaking directly to them or their specific set of circumstances. And the reason I'm not doing that is because I don't know what they are. I don't know what your specific circumstances are. And I know it's frustrating. And that's one of the reasons you have to call, because this may not be the right thing. It really depends. There's so much more to go through that it's kind of funny. But anyway, this is one of the better investments for fixed income. And again, it was years before I would look at these things. The returns, the income returns, were just not that competitive. And I'm looking at it and going, well, why would you do that? Yeah. So, but that all changed a couple of years ago. Rates came down, and the rates on these actually increased a little bit. So that's a really good thing. And to be able to say, all right, I'm going to take this percentage of my money, I'm just going to invest it over here, and it's going to generate this amount of income. So worst case scenario, as I get my Social Security, plus I got that income coming from there, great. If you can cover your basic living expenses that way, that is awesome. That's a big part of our planning process. How do we get your basic living expenses covered by sources of guaranteed income? Social Security, pensions. You might have rental properties. Those are not as guaranteed because anybody that has ever owned property knows people move in and out, and the income that you get is pretty good, but it's also variable. And these are just fixed. You know exactly what it's going to be. They just deposit it into your checking account once a month, and you're good to go. And that's what I really like about it, is just being able to relax. Look, I know I've got this amount of money. I'm getting this much from Social Security. I've got this much from whatever other sources, maybe no other sources. In fact, most people could get by on the Social Security plus, the supplement with this pretty easily, and then I don't have to worry about it. Now all I have to worry about is finding something to do so that I don't bore myself to death in retirement. And, I hear that a lot, by the way. It's pretty funny. Some of the planning processes, they forget to plan on what they're going to do with their days when they don't have to show up for work anymore. And everybody's a little bit different that way too. My goal is to be able to work at Lowe's, because my dad was a carpenter, and we used to say sawdust gets in your blood. And I just love going in there and looking at all the tools and how easy these things make your life as a carpenter. And so I'd really love to. I'll probably get fired for looking at all the tools and not doing my work. But anyway, you got to start thinking about, hey, well, what are you going to do? What are you going to fill your days with when you reach that time period? And those are really important things. I see people that don't do that, and they end up miserable for a time. And a bunch of them will decide that, I'm just going to go get a job, and go have some sort of purpose in life. And that's great. And maybe you want to do a lot of charity work, but do a lot of volunteer work. It's a lot easier to do that kind of stuff when you know that you have a certain amount of income coming in. That's my point. You know you have a certain amount of income coming in. If you're investing in short-term CDs right now, the short-term CD rates are higher, or Treasury rates are higher than long-term Treasury rates are. What does that mean? Well, I don't know. Could they go higher? Yes, they could still go higher from here. And then you might get a slightly higher income. The thing is, when they go back down, those are going back down too. When rates start to drop again, those short-term rates are going down. This one stays the same. And the risk there is that rates go up like they did in the 1970s, and you miss out on a portion of that with a portion of your money. I never believe you should put all your money in any one thing. But that would be the fear of missing out risk. The other risk is that if you take the short-term stuff, CDs, money market accounts, and then rates go back down again, you're going with it, and you'll miss out on the current rates that you have today. So this is one of the reasons that diversification is so important. If you wanted to, and you felt like, well, I can make it on a 6% withdrawal rate, no sweat, for the rest of my life. Okay, then put as much as you want in there, as long as you're really sure about that. That's one of the jobs of an advisor, is to take a look at the whole picture. Bring your attention to those areas you may not have thought about. You say, have you thought about this? And, okay, if that happens, then what are we going to do? And then you develop the plan. You try to develop the plan around your specific circumstances. And that's why you can't really make a blanket recommendation on just about anything. I know people who their kids and grandkids would probably really benefit if they had more money in stock, but they just can't stand taking any risk, none whatsoever. So, and there are lots of people like that, and it's a little unfortunate, because they're never going to outlive their money. And their kids are going to inherit money. They don't understand that. Yeah, if you structured it correctly, or took some time, talk to an estate planning attorney, maybe a CPA. I've got one you can talk to. You could actually have that money grow, and when they started cashing it in, they would actually be able to convert over to long-term capital gains tax treatment, and in some cases, you can even eliminate a lot of the taxes. It just really depends on what you're doing. it's hard to eliminate the taxes, by the way, but you can definitely minimize them. So a lot to think about. I mean, I get it. There is a lot to think about. But once you get those essential expenses covered, I've got X amount of dollars I know I'm going to have to pay for the rest of my life, whatever that is, property tax and the properties, whatever it is, add it all together, but try to come up with a good estimate. Try to have as much of that covered by guaranteed payments as you can. And then once you have covered your basic living expenses, now you can invest the other money more liberally, i.e. stock funds. How are you going to invest those stock funds? Well, you guys all need to write this down unless you're driving, which is probably 3 out of 4 people listening. So don't write this down, just call me. It's pretty funny. I just forgot what I was going to say. When you've got exchange traded funds and they're in a taxable account, because they're exchange traded funds, they get treated differently from a tax standpoint. All the little transactions that are going on each day to rebalance those portfolios are done on a tax deferred basis in the vast majority of them. So you have to check with your advisor, not all of them. But in the vast majority of exchange traded funds that are investing in stock, when they're making the adjustments, which they all are, they're not distributing capital gains the way that a mutual fund would. Not all of them. And a lot of them will defer those gains, and actually those gains will get converted into long-term capital gains, even if they were short-term capital gains that went on inside the fund. That's one of the reasons I like exchange-traded funds more than regular mutual funds. It is that they definitely have a tax advantage. And I've only got about 45 seconds here before I have to take a commercial break. If you have a phone call, question, or comment, 216-901-0945. And this is Bill Bullington right here on 1420. I'll be back after these commercial messages.
These tears will just be tears falling down my face.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Well, Crab Fest is over at the Lobster Pot, but don't fret because Clam Fest has just begun. All through September and October, the Lobster Pot is offering their annual clam bake, which includes a dozen clams, a half-baked chicken, a cup of their famous clam chowder, clam broth, red skin potatoes, and coleslaw. Forget this, only $40. And if you want to add on to your bake, choose a filet mignon, a ribeye steak, a live lobster, a 6-ounce lobster tail, extra clams, or a half-pound of snow crab. And it's all available for takeout. And don't forget about the Lobster Pot's beautiful enclosed outdoor patio for all of those beautiful summer and fall evenings. That's Clam Fest all through September and October at the Lobster Pot. Call now for reservations at 440-569-1634. That's 440-569-1634. Or go to their website, thelobsterpot.com.
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit joycefactorydirect.com. You've heard the saying, all good things come to an end. Well, not always. Sometimes they just take a break. That's what's happening with Our Lady of the Wayside's car donation program after 24 years and 96,000 rides donated. Pretty amazing. Here's the story. The car lot's owners sold the property, making it impossible for car donations to be accepted at this time. According to the Wayside CEO, Terry Davis, the next right steps will be determined and communicated soon, so stay tuned. In the meantime, Terry and the entire team at the Wayside thank you for your continued support of the 450 individuals with developmental disabilities in the Wayside's care. And please take note, you can still support them by making a donation at thewayside.org.
All right. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. And you can reach me going to my website, bullingtoncapital.com. You can call me in the office, 330-664-0700. And I will try to get back to you as quickly as I can. I've got a caller on the line. And Bob, you're on the Bullington Capital Report.
Hey, Bill. How you doing?
Good. How are you?
Good. Hey, what's your thoughts on moving, not a lot, but a small portion of your money that you may have had in short-term duration paper to a longer-term duration paper now that interest rates maybe be peaking and start to trickle back down? And specifically, if you're looking at Roth money.
You're probably going to take a whooping if you do that.
Really?
Because the longer-term paper, especially if it's in a fund, the longer-term paper is going to
keep it out of funds. Just go straight for the certain papers.
Well, what'll happen is you'll see the prices drop. Let's say you bought treasuries, and rates start to go back up. The price on that on a long-term treasury drops about 15% for every 1% that interest rates go up by. And,
but I'm thinking they've already pretty close to peaked, or they will peak very soon, and they're going to start dropping.
Oh, well, in that case, because you just said they were going to go up.
No, if I did, it was a misspoke. Misspoke on that one.
That was the opposite. I was like, I don't know. And they could. That's the thing with interest rates being where they are right now. Man, if you ever get a hint from somebody you know at the Fed, let me know.
Yeah, well, that'd be nice. But sorry, that line got up on me.
Yeah. It's the if interest rates start to continue to creep back up or go higher, obviously those bond prices are going to drop. If this economy continues to slow down, and they in fact start to reverse and start to cut rates, then those bond prices will go up. Now all you have to do is have a crystal ball that works.
Well, yeah, but aren't they paying you? And I'm looking at, aren't they paying you quarterly to hold that money?
Yeah, but it's not going to make you feel too good if you see the price of that bond drop by 15 to 20% or so.
Well, that's true.
Yeah, I mean, there'll be some consolation that you're getting a 4% return, but when you look at the 25% drop in the price of the bond, that you have to wait until it either matures to get that money back, or hope that interest rates reverse whatever course they're on. That's the tough part. I mean, and where we are today, it is incredibly difficult because of you have so many things that, quite frankly, they shouldn't be happening at the same time. You shouldn't have growth that's as going as fast as it is when you've got a war that's being fought and battling supply chain issues. It shouldn't happen, but it is. And so again, when they say it's different this time, people have no idea how different this one is. And it's been different most of the time since I've been watching this stuff, and it's almost never repeated the same way exactly that it laid out in the past. But I don't know. So, what are your thoughts? What do you think may happen?
If the government is paying me a guaranteed interest rate of 5-6%, not even a government, just insured kind of paper at 6%, and the market's going to start turning even for a little bit, as long as you can get in and out of that paper, you could probably make a good buck.
Yeah, you're going to have to but you're going to have to predict exactly what's going to happen to do that. And if you're off by a little bit, the consequences are significant. That's a risk. I just wouldn't want to take that risk, because there are no super short-term bonds paying 6% from a company that's got a good credit rating.
I'm saying you got to look at longer term. You go out of your short term now and move it a very small portion, to longer term bonds that are paying a nice rate. That's what I was looking at.
Well, there would be just my experience in the fixed income market. If something is paying more than 2%, 200 basis points above Treasuries, there's real risk there, because they wouldn't be paying that if they were AAA rated. If it was really safe, they're paying you to take the risk that they might not be able to pay that back. Because 200 basis points is a lot.
Yes, it is.
That's a big spread. Yep. So and believe me, I got my head kicked in when I was young 3 or 4 times doing something like that. One of them, it was the bond was only like 9 months to maturity, and Warren Buffett had just purchased a bunch of the bonds. This guy named Robert Rodriguez had just purchased he was the Peter Lynch of junk bonds, and these guys were showing $2 billion in cash and only $1 billion coming due by the time this bond was going to mature in 9 months. And literally 6 weeks before they were paid that bond off, they filed for bankruptcy.
Oh, God.
And I mean, if there was ever a can't miss, that was a can't miss opportunity. Unfortunately, somebody had not been entering the data in exactly correctly, and it blew up. And Gary Wendt, he used to be the head of GE Capital. He lost most of his money.
Well, thanks for the input.
And by the way, Gary Wendt had actually taken a job with that company. He was the head of GE Finance for years and years and years. And he took a job with it and invested a huge chunk of his own net worth in those same bonds. I thought, I was like, oh, this is easy. All these super smart guys in there, up on this stuff, and this is going to be great. And I'm like, wow, man. So it was a good lesson. I wish I would have been able to learn it from someone else's experience. But,
all right. Well, thanks for the input. Appreciate it.
Well, thanks for calling. I appreciate it. Have a good day. So if you that was one of those sure things that brings back a lot of memories. I'm not a big fan of corporate debt, That's buying bonds from a company, and I've just seen way too many things happen there. So I kind of like to stick to treasuries. You can get CDs that are brokered between banks. They buy and sell CDs just like they do bonds, and which one of them is going to pay the most at any given time, you have to really take a look at it. And that's one of the reasons I like. One of my custodians is Fidelity, and I can go in and look at all this stuff. I can look and see what the treasuries are paying, what high-quality corporate bonds are paying, what junk bonds are paying. If you want to do that, I'm not a big fan anymore. I just don't have the time for that. But and I did want to make a kind of an announcement that at some point in time, it's going to be in a relatively near term. We'll actually do another seminar, and we'll talk about stocks. And I didn't get to talk as much about stocks. I got a few minutes left here today. And I'm going to tell you that today, now that the computers have taken over, most of the trading, more than 90% of it, is done by an algorithm. That's a mathematical formula that gets executed by a computer. Now, it does leave some openings there, because every once in a while, actually fairly frequently, stocks won't be included in a lot of those algorithms because they don't meet certain criteria. Certain stocks will be sold because they don't meet criteria. Well, that criteria is very specific, and it's not flexible. And I think it's opening up some opportunities in stocks, but you got to have a lot of patience. You have to kind of know what you're doing. And the first thing you really want to do is pick from lists of companies who have the underlying fundamental characteristics that have a tendency to lead to good long-term gain. Okay. What I would tell you is that there is a book. It's called the Magic Formula, and I would get that. Or I'm sorry, not Magic Formula. That's the website. The little book that beats the market. Joel Greenblatt. He's kind of an investor right along the lines of Warren Buffett, and he put that book out there. He's put a website, and I'll start to talk about those things. I was looking at it today, and I see a lot of names of companies that I've owned before, and I think you can own them. We're typically not supposed to make stock recommendations on individual stocks, but if you have you got a company that you want me to look up, I can actually look up, and according to the criteria, I can give you an opinion of it. So anyway, I'm sorry I didn't get to spend as much time on stocks. I promise, no matter what happens next week, maybe I'll just start the show with doing the individual stocks next week. But if you have any questions regarding anything you heard here today at all, want to get an estimate on what your own retirement might look like, feel free to give me a call or go to my website at bullingtoncapital.com. And hope you guys have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.